Okay, well, thank you very much for inviting me. It's really a pleasure to be, even if it's only virtually, in with you in Santiago. The title of the paper I'm giving has changed a little bit, but it's on the same topic. It's now called Capital Flow Management, Basis Control, and I'm going to explain what I mean by that in a minute. So the motivation for this paper is very much linked to a lot of the themes that we've already talked about in the conference today. And in particular, what I was interested in is the implementation of capital flow management, which is an issue that many emerging market economies and maybe some small open advanced economies are thinking about. And I was taking stock of the recent literature. There's a very interesting and rich literature, a theoretical literature mostly, that discusses the importance of macroprudential policies for capital flow management and foreign exchange interventions. And that literature, key insight is that the implementation of these policies, especially on their prudential side, is designed to correct some important externalities, and Martin and Stephanie are important contributors to this research agenda. There are a number of externalities that have been identified and studied in the theoretical literature: aggregate demand externality, pecuniary externality, terms of trade externality that goes back further in time in terms of the intellectual development of the field. And all of these motives for interventions and prudential interventions are gradually incorporated in the policy framework that institutions like the IMF are putting together. For instance, their integrated policy framework is building on these important insights. Now, one key consideration that emerges from this theoretical literature is that the implementation problem can be quite complex. And typically, and I'm going to show you some examples of this, you're solving a constrained efficient optimization problem, looking at things from the point of view of a small economy planner, benevolent planner that's facing the same kind of frictions and constraints that the decentralized environment has. And you're incorporating and internalizing these externalities, and that provides an optimal, if you want, tax or capital flow management. But that object is often a relatively complex state-dependent object and is not easily characterized. And so what I've attempted to do here is something that is quite simple. I'm ashamed to say it's extremely simple. I've tried to identify an environment where we could have a simple rule for setting some of these capital flow management in terms of observables. And I put observables in quotation marks here, in quotes, because as you will see, it's not, there are interesting issues about measurement. And one such observable, which I think is particularly relevant for many emerging market economies, especially when currency markets are shallow, is what is called the CIP deviation, the deviation from covered interest parity. And I'm going to call that, in the remaining of my talk, I'm going to call this the basis. And so this is what I mean by basis control, is can we think of situations where the central bank would want to, in addition to its interest rate instrument, would want to also maybe deploy capital flow management in a way that would target or try to control the size of the basis that it's facing. So the deviation between the, if you want, the local interest rate and the swapped foreign interest rate. Okay, and so here I'm going to first review a little bit some of the empirical evidence on this, especially for emerging market economies. And I'm going to present a very, very simple model that borrows from some recent work that illustrates how this could be implemented at least in this simple environment. So the simple way to define the basis, the way the empirical literature does it, or financial markets do it, is the difference between the cash dollar rate, IT dollar here, and the equivalent synthetic rate that you can obtain by taking your local short rate and swapping it into dollars using the spot and forward market. And so here, the way it's defined, the basis is going to be negative when the dollar rate, the cash dollar rate, is lower than the synthetic dollar rate. So when dollars are synthesized or dollars available offshore are more expensive. Now, we all know that for advanced economies, especially prior to the global financial crisis, the deviation from CIP, or in other words, the basis, was extremely small. And then we also all know from the work of Wenxin Du and various co-authors that a deviation from covered interest parity became much, much larger during the global financial crisis and then even after the global financial crisis. Now, the question is, what do we know about the CIP deviation from emerging market economies? And here, simple measures, sort of naive measures, if you just take some sort of yield, so let's say a 3 months rate here for the dollar rate and a 3 months local rate, or you could do it with 1 year rates or 5 year rates. If you just construct the CIP basis in the same way, you would come up with much larger estimates of the CIP deviation, even before the global financial crisis for emerging market economies. But there's one important issue there, which is that this may not be capturing sort of riskless arbitrage. It may also be due to credit risk. And Wenxin Du and Jesse Schreger in the Journal of Finance paper in 2016 actually made a strong argument that a lot of what we would call CIP deviation for emerging market economies is actually reflecting credit risk and not sort of the constraints on the balance sheet of the financial intermediaries. But more generally, if there is any, I'm going to argue that there are ways in which we can measure what I would call the true CIP deviation. That CIP deviation reflects the shadow cost of dollar balance sheet expansion for global financial intermediaries. And it implies, if there is one, it implies that there are different rates that the domestic agents are facing. And you could rewrite this basis as basically when it's not zero, as having a different policy rate in the country and having a different policy rate that would be obtained by taking the dollar rate and swapping it. And that creates potential challenges for the transmission of domestic monetary policy. That's a point that Maury Obsfeld has made in a recent GIE paper in 2020. And so here, the gap between these two local rates is going to be the object of interest. And I want to ask, when is it optimal to express a target for this basis? And how would we implement that? Okay. Now, let me illustrate a little bit empirically what I have in mind. So here on the left, I'm showing a graph that I'm sure many of you have seen, which is the basis constructed for a group of advanced economies. So I'm taking Japan, Switzerland, the UK, and the Euro area. And I'm starting in 2000. And you can see there that, of course, as we well know, the CIP deviations were tiny before the global financial crisis, and then they became large and more generally negative for most of the currencies. I mean, some countries have a positive basis, like Australia, but a lot of countries, advanced economies, have negative basis during the global financial crisis and aftermath, meaning that the cash dollar rate was cheaper than the synthetic dollar rate. Now, on the right, what I'm doing is I'm doing the same thing, and this is for a 3 months LIBOR CIP deviation. So at a relatively short end of the maturity spectrum, I'm plotting the same object for 5 emerging market economies. I mean, Korea probably doesn't belong in the group of emerging market economies, so depending how you look at it, certainly not by their standards of living, but Israel, Malaysia, Mexico, and since we're at the Banco Central de Chile, the last country I'm looking at is Chile here. And notice that here we see, I'm trying to go back in time as much as I can with this measure here. I'm starting in 2000 again. Not all the countries are available in 2000. Chile, in the data I have, starts only in 2006. But we see significant deviations from CIP, and we see them, and they are on a much larger scale. If you look at the scale here on the axis, than for advanced economies. So we're talking about hundreds of basis points potentially, even before the global financial crisis. Now, as I said, one of the concerns one might have is that this might not be reflecting just the constraints on the balance sheet of financial intermediaries, but also maybe some credit risk that some of these countries may have been facing at various points in time. And so it's a little bit hard to interpret this purely as a constraint, as a shadow cost on the balance sheet. What you can do, and this is something that I borrow again from the work of Wenxin Du and Jesse Schreger, what you can do is you can construct a measure of CIP using supranational borrowings. And so here it turns out that there are a number of financial institutions, international financial institutions like the European Investment Bank, or even national institutions like KfW, which is an institution that is fully backed by the German government. And these institutions borrow typically in multiple currencies, including the currencies of emerging market economies. And so here I'm showing you for for Turkey, so this is the EIB, this is the CIP deviation constructed for Turkey using the yield, the 5-year yield that the European Investment Bank paid on its borrowing in Turkish lira versus what it would pay on borrowing in US dollars. And now, of course, because you're looking at this, you're controlling for the same borrower, which effectively has zero credit risk. It's an international, it's a supranational borrower. You're measuring really, truly something that is much closer to the cost of the balance sheet expansion. And here, what you see there is that before the global financial crisis, so in blue, you have the Turkish lira CIP deviation constructed using the supranational. You also have the Brazilian real CIP deviation constructed using KfW. I'm only showing this two currencies here. It's a little bit more complicated to construct because you have to you have to get the bonds issued by these currencies, by these different institutions. You have to construct the equivalent of a zero coupon curve, and then you have to sort of construct your CIP deviation based on that. So I'm directly borrowing the work that Wang Xindu and Jesse Schrager have done for me, in a sense, and showing you these deviations for these two currencies. And in the other lines here are just again the advanced economies CIP deviation prior to the global financial crisis. Now, what you can very clearly see there is that there are much larger CIP deviations for emerging market economies, at least the two that I'm showing you, prior to the global financial crisis. Post-global financial crisis, interestingly, the deviations look very similar in magnitude. So again, you see in blue and in orange, the Turkish lira and the Brazilian real, they are not that different in terms of size compared to the Japanese yen or the Swiss franc. So it looks as if the world has sort of moved in the direction where now more countries are experiencing CIP deviations of the size that maybe only emerging markets were experiencing before. Now, it's still the case that these CIP deviations are much smaller than what I showed you on the previous slide. In other words, the naive CIP deviation, and even smaller than what Shebnem was showing us in a presentation this morning. In other words, the UIP deviations are even larger than this. But then I want to focus narrowly on this measure of shadow cost expansion. So I'm going to take it as sort of suggestive evidence. It's not the final word, but suggestive evidence that this deviation from CIP are actually quite relevant. They can reach tens of basis points. In the graph I'm showing you for the Turkish lira, it can easily be representing 80 basis points. For Brazilian real, it looks like to be a little bit smaller, maybe around 40 basis points, but that's still something that is quite significant. Okay, this slide here is showing you the same calculation. If I compare the CIP deviations and I look at the same maturity, so instead of having the LIBOR for the advanced economies, I'm also looking at the 5-year CIP deviation for those countries as well, and the same message emerges that, yes, you get slightly larger spreads for advanced economies, but still much smaller than emerging markets prior to the global financial crisis. All right, so then that brings me to the question. So now that I've sort of hopefully established for you that there is an object to look at, that is something we can study here, then can this basis inform policymakers about optimal interventions, whether capital flow management or foreign exchange interventions? And so to approach this question, I'm going to adapt a recent model that Javier Bianchi and Guido Lorenzoni have written for their handbook chapter of international macroeconomics that builds on the work of Martine and Stephanie and of many others that looks at environments in which you have room for prudential interventions. And so I'm going to simplify and strip down even further their models to get something that is extremely simple. So imagine that you have an environment where a small open economy is interacting with the rest of the world, and that's a two-sector world. You have a traded good that's in a fixed endowment, YT, does not get fluctuate over time, does not sort of shutting down, if you want, productivity shocks or commodity fluctuations here. And there is a non-traded sector that is producing a good using labor with a linear production function. Now, I'm going to assume that there is a representative household in this environment, and this representative household has preferences that are separable between traded and non-traded. So sigma here is the inverse of the elasticity of intertemporal elasticity of substitution, and also the inverse of the elasticity of substitution between the traded and the non-traded goods. And phi controls the openness of the economy, so the reliance on the traded good. And that economy has access to a foreign asset. It can borrow in foreign currency. So T star is the amount you borrow at time T in foreign currency. And then the next period, you're going to repay a certain interest. And the interest you repay is going to be the dollar interest rate plus here's some spread. I'm going to call that spread X for the time being. So it's a spread over the dollar if you want a dollar risk-free rate or the policy rate that is set by in the rest of the world. Pricing is going to be competitive, so the traded goods price is just going to be the nominal exchange rate ST between the home currency and the dollar. The wage is going to be equal to the price of the non-traded good given the linear technology. And I'm going to assume that wages are downwardly sticky here so that there is some aggregate demand externality that's going to come and play a role. Okay, so now on the funding side, where I'm going to get some traction, I need to think about where this spread, this XT is coming from. And so rather than assuming that it's just some exogenous object, here I'm going to assume that there are foreign financial intermediaries, foreign banks that are lending these dollars to the small open economy. And they are lending them at this rate, RT star plus XT, the spread XT. And those foreign financial intermediaries can borrow at the rate RT star. So XT is really their margin on every dollar that they lend. And I'm going to assume that they're facing some implicit balance sheet expansion cost here. That is, I'm going to make quadratic to keep things simple. So they're effectively maximizing the spread times the quantity of dollars that they lend minus this balance sheet expansion cost that is quadratic in the size of the balance sheet of their dollar lending. And that's going to give you this very simple expression here that in equilibrium, the amount they're going to lend is going to be proportional to the spread. And this omega t here, this coefficient here that's in the balance sheet expansion cost, is going to control the elasticity of the supply of dollars. If this omega is infinity, there is no friction. If this omega is zero, there is no funding. Okay, and that can be fluctuating over time. And that's the way I'm going to think about, like Javier and Guido in their paper. I'm going to think about times when there maybe is a tightening of the funding. Of the dollar funding for that small open economy. A lower omega is going to be a tightening of the funding constraint. Now here, I introduced the spread, but I started my talk talking about the basis. So what is the link between the spread and the basis? Well, it turns out that in the environment I'm describing, the two are going to be equal. And so how can we see that? Well, we can define the basis again, and they're going to be equal with opposite signs. But the basis is just going to be the log of the policy rate in the US, or the risk-free rate in the US, minus the swapped dollar, synthetic dollar rate obtained from the local interest rate swapped into dollars. And so you can imagine what a local bank might do. A local bank might borrow at this dollar rate. It can only access dollars at this RT star plus XT. And it could swap that and deposit it locally. And of course, in equilibrium, that cannot be profitable. And so that's telling you this inequality here, if you rewrite it a little bit, it's telling you that the basis has to be above the opposite of the spread that the foreign intermediaries are charging. So there's a lower bound on the basis here. You can alternatively, you can think about the local bank borrowing at the local rate and then investing abroad. If it does that, it's investing at the rate without the spread, RT star, and that provides another bound that cannot be profitable, and that provides another bound on the basis, so the basis to be negative here. So the basis is going to be in between the spread that the intermediaries are charging and zero. And in fact, you could even think about a local bank that would synthesize loans to local investors using the local interest rate on the swap market. And clearly, if it does it and it's cheaper than the foreign interest rate with the spread, then the foreign intermediaries would have no market share. And so they're going to make sure that this isn't happening. And so in fact, what this implies is that the basis is just the opposite of the spread. So when I wanted to have a setup where this is the object of interest, and that's what we obtain here. Okay. Now, I have an equation that controls the supply of dollars. I need an equation that controls the demand for dollars. And so that's coming just from this representative agent that is deciding how much to consume and how much to save and go into the next period. And here, if you solve for the competitive equilibrium, in the limit where the discount factor is equal to 1, so you can simplify a bunch of terms, and also in the limit where after period t, everything is going to be flexible and there's not going to be any funding constraint. And effectively, this local representative agent is going to have to decide how much to borrow in dollars versus how much to save. And you can have a very simple expression here that represents the discounted value of output in the future minus the income that is available today after repayment of pre-existing debts. That's this BT star is a repayment of debt inherited from the past. So that gives you a sort of a consumption smoothing motive and a demand for dollars. So we have a demand for dollars, we have a supply for dollars, and so we have an equilibrium. And so we can graphically represent this in this diagram here, where I put on the horizontal axis the amount of dollar borrowing, and on the vertical axis, I put xt, the spread, or equivalently the opposite of the basis. And so an equilibrium is going to be at a point where one is downward sloping, one is upward sloping, everything is nicely behaved. Now, what is a tightening of the funding constraint? Well, it's going to be a rotation of this funding curve here. It means that the dollars are going to become more expensive or less freely available. And in this competitive equilibrium, you see that it's going to reduce the amount you borrow, and it's going to increase the basis, going to increase the spread that you're facing. The lenders don't want to lend to you, it's going to be more expensive, and you're going to borrow less. Now, the externality in this world is coming from the fact that with nominal rigidities, and if the exchange rate is insufficiently flexible, then the reduction in borrowing implies that you also have a reduction in consumption of the traded good. And if you have a reduction in consumption of the traded good, that means a reduction in the consumption of the non-traded good. And the reduction in consumption of the non-traded good could trigger a recession in the domestic economy. Again, this is a standard mechanism that has been studied many, many times. This is a disaggregated demand externality. Now, monetary policy can intervene and ensure that this doesn't happen by letting the currency depreciate enough. If the currency of the exchange rate depreciates enough, then you can always increase this ST sufficiently that this will offset the fact that you don't consume much of the traded goods. But I'm going to think about a world in which, in general, it might be difficult for the central bank to do this, maybe out of concerns for excessive volatility on exchange rate, or maybe there could be other things that the exchange rate is doing to the economy, like tightening collateral constraints and things like that are unpleasant, and as a result are undesirable. And so in this world, if the exchange rate cannot adjust, if letting your exchange rate adjust freely is not feasible, then you're going to want to use both ex-ante and exposed other instruments to try to maybe control and take into account this aggregate demand externality. Now, the two externalities are the terms of trade. It's costly to borrow, and the more you borrow, the more expensive it becomes. That's this funding curve that is upward sloping, and then this aggregate demand externality. Now, you can solve for what a planner would do faced with the same externalities, and the planner would basically allocate consumption of the traded good or the amount of dollar borrowing, taking into account both of them. If there is no recession at time t, then effectively the planner only cares about the terms of trade and wants to reduce borrowing because borrowing is expensive, and wants to reduce borrowing for the usual terms of trade reason. And you can see that the amount of borrowing decreases because the planner acts as if the spread is actually larger than it is. If, on the other hand, you have a recession at time t, then the planner has to balance two different objectives. On the one hand, it doesn't want to borrow too much at the time of trade, but on the other hand, this is a recession, and you want to make sure there is enough consumption of the traded good so that you avoid the recession. And we can, in the simple model I have here, this second motive, which is controlled by this phi here, which is the openness of the economy, is going to dominate. And so if a recession hits, in the crisis management, you want to make sure that you borrow more, and as a result, the basis is going to rise. So you can characterize this graphically by, this diagram, by plotting the amount of dollars you borrow against the basis, xt, or the spread. This is the equilibrium in a competitive environment when you have a tightening of the funding constraint. Now, if the economy is not going to be in a recession, then the red curve, the lower red curve, is what the planner would like to do. It's going to want to sort of control the terms of trade externality, reduce borrowing, and by reducing borrowing, also reduce the rise in the spread. But if the economy sort of goes into a recession, then at that point, it will want to let the basis expand and make sure that there is enough dollar borrowing to make sure that it avoids a recession. So in a sense here, you can see that at the time before the recession, it might want to be at a point like point B. If a recession hits due to the funding constraint, it will want to go to a point like C prime. So effectively, it wants to let borrowing increase, and it may want to let the basis expand dramatically. So there is a message here in terms of the optimal capital flow management, that you want to use capital flow management to reduce borrowing in the first place. But if you're hit by a crisis, then you actually want to subsidize, you want to relax the basis. Now we can characterize this we can characterize this. I'm going to show you the characterization in a minute. Now you can also ask ex ante, what would I want to do? Now ex ante, and this is the prudential part of the paper. Ex ante, these two externalities are sort of going in the same direction. Ex ante, you would want to reduce borrowing so that you don't have as much to repay in the exposed stage, and therefore you can afford a higher level of consumption of the traded good. And you can see that in the Planner's Euler equation here, which is acting as if it's facing a higher spread, and it's also taking into account the fact that it might be a recession tomorrow. So these two terms here are both pushing in a direction of keeping the basis relatively tight and reducing borrowing. So how could we implement this? Well, it turns out that in the simple model I'm showing you, it's very, very simple. Exposed, at least very simple exposed, slightly more complicated ex ante. Exposed, basically, you would want to set a capital flow management, a tax on inflows, that is just going to be a function of the observed basis. If you set the capital flow management equal to this expression here, which is approximately just the spread, that is going to deliver the Planner's solution. If instead you have a recession, then you want to adjust the basis, and actually you want to set it according to this formula, which is basically, again, the basis, but adjusted by a constant that takes into account the aggregate demand externality. And so the optimal tax is actually state contingent, depending on whether you have a recession or not, but the only other determinant is the size of the basis. And so more generally, you can imagine having a rule that would set a tax on capital inflows, for instance, as a function of the observed basis at a point in time, and an indicator as to whether the economy is in a recession or not. And the last term here, which is the expected value of the basis tomorrow, so maybe one needs information about the term structure of the CIP deviations, is capturing the prudential part of the policy that basically tries to adjust for the fact that there might be a constraint in the future. I only have a few minutes left, so let me just make two more points very briefly. The first one is that it's a policy that can be implemented relatively easily with capital flow management or taxes on capital inflows. It cannot be implemented as easily with foreign exchange interventions. And the reason is that foreign exchange interventions in the form of saving in say, dollar assets for the future, they're helpful exposed. So at the exposed stage, they basically shift the demand for dollars. And so that, again, helps you reduce the basis that you're going to face and allows you to maybe avoid a recession or as big of a recession. But ex ante, they lead to additional borrowing because agents in the economy are actually going to end up being poorer. There's a quasi cost of having a fiscal foreign exchange intervention. You're earning only the dollar interest rate, and when you're borrowing in dollars, you're borrowing at the rate including the spread, and that leads to additional borrowing ex ante. So it doesn't look like it's going in the right direction ex ante. One last thing I want to mention, and then let me close. What if you have access to swap lines? So that's something that's been discussed. That's certainly something that is part of the policy toolkit. And so here you can imagine what happens if the foreign central bank has access to a swap line, maybe with the US, the Fed, or maybe with the IMF, that gives it dollars at a spread, XS, all these swap lines have a spread on the dollar rate in times of stress. What this would do is it would flatten the supply of dollars at that spread, at that value of the spread. And it does two things. The first thing is that if you're not in a recession, it removes the terms of trade externality because you cannot manipulate the rate at which you would be borrowing now that it's set by the foreign central bank. And so that means that your Planner's solution coincides with the competitive equilibrium if you don't have a recession. It also means that if you do have a recession, then the only thing you care about is the aggregate demand externality. And so then in that case, you would actually expand borrowing a lot because you don't face the adverse pricing component here on the spread. And so in that situation, again, you lose the simple result, which I developed earlier, which is that the optimal tax is a function of the basis. The basis becomes determined elsewhere by the foreign central bank, and your optimal tax is just offsetting the aggregate demand externality. Okay, so let me mention just one thing about, I've told you that in the simple model, the spread is linked to the balance sheet expansion. You might say, well, but we don't observe it. Could we do this by just looking at the naive CIP, or could we do this by looking at UIP condition? And well, probably not. And in principle, the little model I have could be interpreted either way. But I think there are good reasons to be worried about trying to target UIP deviations. As Shebnam's paper showed us earlier this morning, there's a component of UIP deviations that is likely to be homegrown, related to policy credibility and risk premia that we don't want to take as given or as exogenous. And the same is true for naive CIP deviations that I mentioned earlier, to the extent that it's actually capturing something that is like credit risk. So for both of these reasons, I think what you really want to capture is what is coming from the slope of the funding curve that's coming from the rest of the world. So to conclude, the little bell is ringing, so I'm gonna stop now. The paper asks a simple question: can we use the cross-currency basis as a target for an additional instrument when we want to introduce exponential measures? I've shown a very simple, naive environment where this would be the case, where you have a simple rule that would deliver the planner's solution. Whether that can be extended to more complex environments, of course, that remains to be seen, but I think that's a promising, in my view, that's a promising way to approach a relatively complex problem and maybe make it more tractable. Thank you.